Welcome to Module 3, the numbers. So why do the numbers matter so much in commercial property? Well, we invest in property to make money and build wealth through capital and cash flow. The whole reason we invest is for the dollars, so that's why the numbers matter. It's important to use objective measurements to determine whether a property is worth buying and if it will make a good investment. Each lesson in this module will look at a different set of numbers that you need to analyse when you're considering an investment purchase. These include the purchasing costs, the yields, leases, outgoings, depreciation, the capitalisation rate and property value, cash flow, return on investment, capital growth, and growing your portfolio. So let's jump straight into next lesson by looking at the purchasing costs. See you then. Welcome back to Module 3, where we'll cover all of the purchasing costs associated with buying a commercial property. Commercial properties have the same purchasing costs as residential properties, but with a couple of additions. A rough estimate used in the industry is that buying costs outside of your deposit will equate to about 5% of the purchase price. If you're looking at a $1 million purchase price, then your purchasing costs are expected to be around $50,000. So let's talk deposits. As we talked about in Module 1, you'll need a larger deposit on a commercial property. Some lenders offer between 60 and 70% and even up to 80% of loan to value ratio, so you need a deposit between 20 and 40%. Once you've spoken with a commercial broker or lender and know the deposit required, you can then work out your purchase price budget. A simple way to do this is to divide your available deposit by the lender's deposit requirements and add 5% to cover such items as legal costs, inspections, valuations, and government taxes. Your available deposit should not include a buffer of your leftover savings. For example, say you have $150,000 to spend and the lender requires a 30% deposit. You'll also need to allow 5% for purchasing costs, bringing the total up to 35%. If $150,000 represents 35% of the total, then you will divide the cash deposit amount by the deposit and purchasing costs. Then you'll have an approximate purchase price of $428,571. So you should be looking at properties around this price. Now that we know how to calculate the purchase price, let's have a look at what costs make up that 5%. The typical purchasing costs are stamp duty, goods and service tax or GST, legal or conveyancing fees, the cost of valuation for lending approval, the body corporate inspection report, the cost of the building inspection, the cost of a pest inspection, and the cost of a survey. Before proceeding with the purchase of any investment property, I recommend you obtain quotes on all of these services and seek advice from your accountant. Let's look at each of these purchasing costs in more detail. Firstly, stamp duty. This is a government tax on certain transactions generally applied to when you buy a motor vehicle, an insurance policy, or real estate. Stamp duty on a property is also known as land transfer duty. The stamp duty amount is generally calculated on a sliding scale or tiered levels depending on the Australian state or territory the property is in and the purchase price. This is the big ticket cost when purchasing a property. Some states like the ACT and South Australia don't actually have stamp duty on commercial purchases. There are a number of online websites that allow you to calculate the stamp duty for your property. Goods and service tax. The sale of a commercial premise can attract goods and service tax, or GST. This is currently 10% of the purchase price, so a significant addition to the purchase. GST is generally imposed when a seller is registered or required to be registered for GST and is conducting an enterprise. If you, as a buyer, are registered for GST, it can be claimed back in your next business activity statement, but the money still has to be paid upfront to the seller. There are exemptions to the application of GST, however. For example, a seller doesn't need to apply GST if the property is part of a going concern. The property will be considered a going concern if the sale includes everything that's necessary for the continued operation of the current business, or the business is carried on by the buyer until the day of sale and continues after the day of sale. Basically, leasing a property is deemed a business and therefore a going concern. Simply put, you will only pay GST on a commercial purchase if it is a vacant property. It's important to always seek independent legal and financial advice to ensure you won't pay the GST. One potential way around paying GST is to get the seller to provide a rental guarantee, which is effectively getting a lease from the owner and you don't have to pay GST up front. We'll touch on this again later in the course. Legal or conveyancing fees. Another purchase cost will be your legal or conveyancing fees, which will be paid to your solicitor. These include their fees as well as the cost of any searches they undertake for your purchase. A solicitor's charges for a purchase will usually range from $1,800 to $4,000, depending on the value of the property being purchased and the number of leases. It is essential to make sure you are working with an experienced conveyancer or solicitor who has experience in commercial property. We'll be going into more detail on conveyancing in a later module. Valuation costs. One big difference between residential and commercial are the valuation costs that are incurred when you obtain finance from the lender. Lenders will only accept valuers who are listed on their panel. Charges will typically range from $800 to $3,000 per commercial property purchase, though they can be higher if the property has multiple tenants. Body corporate inspection report. If you're buying a strata property, it's important to get a physical body corporate inspection report. This will identify any issues with a specific lot or common property. It will also notify you of any planned special levies to be imposed after settlement. Building inspections. A building inspection is another important cost that involves paying an inspector to analyse the property and find any defects. An external inspector who hasn't been recommended by the selling agent is preferable, as they'll be unbiased. I recommend using an inspector who takes lots of photos and provides descriptions of each item as opposed to using a tick box form. Building inspections typically cost $350 to $800, and if the building inspector is qualified for pest inspections, this can be performed at the same time. Pest inspections. You'll need a pest inspection as you would for a residential property purchase. You may be able to engage a building inspector who's qualified to perform both building and pest inspections. These inspections cost typically between $200 and $500. Surveying. A property surveyor is a detailed report of a property's condition. Surveyors inspect and create reports detailing structural aspects of the property. If no survey is supplied with the contract of sale, it's wise to have one done. Your solicitor or the selling agent should be able to give you a list of surveyors in the area. Other fees. In addition to the fees already mentioned, there are usually some small miscellaneous fees that are incurred, such as registration and bank fees. In summary, the 5% purchase price rule is just a simple guide and is good to use when working out your budget. Make sure to calculate all these purchase costs and numbers correctly if you're seriously about drilling down into a deal and looking to proceed with a purchase. Well, that brings us to the end of this lesson. Thanks for watching again, guys. See you next one. Welcome to your lesson on yields. As we've discussed, commercial property can provide solid returns. But how can we calculate the returns and compare them between properties? One key number to understand is yields. As we looked at earlier, commercial yields are typically much higher than residential property. So how do we measure it? A commercial yield is measured using the annual rental income the owner receives from the tenant compared with the purchase price, and then expressed as a percentage. There's a lot of debate whether a commercial yield should be calculated and expressed as gross or net, so let's clear that up. While residential yields are gross yields, commercial yields are typically given as net yields. In other words, the commercial yield is calculated based on the net income rather than the gross income. This is where most people get confused. They see 5% yield for residential and commercial and they think they're the same, but they are very different. So what exactly is the difference between gross and net income, and why is it so important when calculating your yield? Gross income is the total income collected from the property. It includes rent and any other extras, such as the payment for electricity, water, rates, property management, and other outgoings if the tenant is paying them. Net income is the gross rental income minus all expenses like council rates, water rates, insurances, maintenance, and property management expenses. It's the amount the owner receives after all expenses have been paid. This excludes your mortgage repayments, however. It's important to know whether the yield you are looking at is gross or net, as this will dramatically change the cash flow. For example, a 6% gross yield can easily drop to 2% yield once all expenses have been taken out. Going back to our formula to calculate the commercial yield, we will take the net income divide it by the property's value, and present it as a percentage. Let's have a look at an example. Firstly, a yield calculation. Our property purchase price is $500,000. The gross income is $43,000. There is $7,000 paid by the owner for outgoings. This means the net rent is $36,000. So to calculate the property yield, we do $36,000 divided by $500,000 times 100, which equals 7.2%. You can also do this calculation in reverse to obtain a purchase price that will give you the yield that you'd like. So our desired yield would be, say, 7.2%. The gross income is $43,000 and there are $7,000 paid by the owner for outgoings again. So the net rent is $36,000. To calculate the purchase price, we do $36,000 divided by 7.2% times 100, which equals $500,000. On average, commercial property yields are around 4 to 8% net. This is a great calculation to use to get an indication of the rate of return a property will generate during ownership. Remember though, yield is just one element to consider when investing in property. Thanks for watching, guys. See you next lesson. Welcome to your next lesson, where we'll be looking at leases. We have split this topic into 2 lessons as there is so much to cover, but let's get into it. You've probably heard of a lease before. Its definition is a legally binding agreement between a property owner and a tenant that allows the tenant to use the property for business purposes in exchange for rent paid to the owner. It's an important document specifying the tenancy terms and conditions such as the rent amount, payment frequency, rental increases, and so on. The lease becomes effective once signed, and its terms bind both parties. Generally, the lease cannot be terminated without the other party's consent, or a break clause will apply and a penalty will be due. For an investor, when you buy a leased property, you're buying a guaranteed income for the duration of the lease, which helps provide stability and security. The tenant benefits by having the security of a long-term location where they can expand their business. However, like any relationship, disputes between the landlord and the tenant can arise, particularly in a multi-tenancy property. Tenants can request rent reductions or penalty-free early exit by reporting conditions like poor temperature control, cleaning standards, or noise levels as a breach of the lease agreement by the owner. Disputes can be expensive and stressful though, and a clear and well-written lease can help prevent this by outlining both parties' expectations and obligations. The lease establishes all conditions between the lessee, which is the tenant, or the lessor, the landlord. It also clarifies the relationship between the 2 parties and ensures that their expectations are clearly understood and documented. So, what's the actual process for getting a lease in place with your tenant? There's sometimes a misconception that commercial leases are a lot trickier and difficult to understand. But with the help of a solicitor, drawing up a lease is usually a straightforward process. Lease negotiations can be intense, particularly when it comes to the length of the agreement. Let's walk through the 4 steps involved in this process. Step 1. Creation and signing of an agreement to lease document. This is the first step of the leasing process and is a non-binding agreement between the landlord and the tenant, outlining the terms and conditions for the future lease. This agreement can be used in situations where the lessor has not yet acquired title to the land, the premises are not fully erected or ready for occupation, the former tenant is still occupying the premises, or all the lease conditions have not yet been settled. Step 2. Submission of the draft lease by the landlord, the lessor. The lessor will prepare a lease based on the criteria outlined in the agreement to lease document. The lease is then sent to the tenant's solicitor who will review it and possibly request changes. The landlord must also submit a disclosure statement, which includes property information such as mortgages, covenants, easements, zoning, and outgoings. The tenant must pay for any registrations and surveys. Step 3. Finalisation of the lease. After both parties have agreed on the lease terms, 3 copies are given to the tenant's solicitor. All copies will be signed by the tenant and returned to the landlord, who will also sign. Both parties will have a completed and signed copy for their records. Security bonds and guarantees are also provided at this stage. Step 4. Registration of the lease. Finally, if the lease period exceeds 3 years, including any renewal options, a memorandum of the lease will be prepared and registered with the Land Registry Services. So now we know the lease process, let's review the mandatory information that must be included in every lease. This includes tenant details, description of the premise and how it will be used, guarantor information, bond details, start and end date of the lease, the length of the lease, options of the lease, how much the rent is, details about rental increases and reviews, details of outgoings the tenant must pay, who has responsibility for repairs and maintenance, usually these are covered by the tenant, the core trading hours and when the premises will be open for business, any additional factors such as fit out or rent-free periods, and insurance. As the buyer, it's unnecessary to understand every detail of the lease because your solicitor will assist you and review all the proposed terms and conditions. However, it is important to have a general understanding of all the terms and conditions that exist in the common lease. This will enable you to negotiate and secure the best lease for your property. So now it's time to look at the different leases used. Types of leases. Commercial leases are classified into 4 types: gross leases, net leases, triple net leases, and absolute net leases. Let's look at what each of these means. A gross lease requires the property owner to cover all outgoings, and the tenant only pays the rent. With this type of lease, the owner faces the risk of rising expenses such as council and water rates and insurance premiums. Since you can't raise the tenant's rent until it's due for review, this can impact your yield and cash flow. Gross leases are more common amongst retail and office spaces. Next is a net lease, where the tenant is responsible for the rent and one or more outgoings. The outgoings payable would be outlined in the lease and disclosure statement for the tenant. The owner will typically be responsible for the property management and land tax. If the property is multi-tenanted, the lease stipulates what portion of each tenant's outgoings would contribute. The benefits of a net lease for the owner is that the tenant pays any increases in outgoings, ensuring that your cash flow calculations remain accurate. Net leases are the most common leases, especially with industrial properties. The third type is a triple net lease. This means the owner is responsible for the structure, roof, and parking area, while the tenant is responsible for all other expenses. Finally, in an absolute net lease, the tenant is responsible for every aspect of the property. In addition to the rent, they will pay all rates, taxes, insurance, and management fees. They will also look after the structure, repairs, and maintenance. These are usually for the large freestanding businesses like Bunnings or Woolworths. So now that you know what kind of leases you can have, let's look at lease periods. Leases can be agreed upon for any period of time, but most small and medium-sized businesses will generally have a 1 to 5 year term. Startups will likely have 1 to 2 years, whereas a well-established business may have 3 to 5 years. Leases for national chain tenants such as large shopping malls, hardware stores, gas stations, and fast food restaurants typically range from 7 to 20 years. You'll also see that leases often have multiple terms and options to renew. For example, if you see 3 by 3 by 3, this means 3 periods of 3 years. At the end of each term, the tenant can either leave or renew the lease. This is a commitment from the owner and tenant that they can be there for 9 years, but they don't have to be. Each time the tenant renews, they are locked in for that period of time. So, what are the benefits of the different lease periods? The pros and cons of lease periods. The lease length is examined closely by the lender when agreeing to finance your property purchase. A newly signed or longer lease can drastically increase the value of a property and the lender will be more likely to finance you. A long lease can save you money on solicitor's fees because the tenant can simply exercise their option to extend the lease term instead of having the solicitor draw up a new lease every time. As an investor, you want the lease to state that the tenant must exercise their option at least 6 months before the lease expires, giving you time to advertise if they do not renew. You should also start discussions with your tenant about 12 months before the end of the lease term. A disadvantage of longer leases is that a long lease limits your ability to change tenants or shop mix until the leases are completed if your investment is a small shopping centre or suburban retail. Additionally, if a tenant has a long lease and the area's zoning changes, utilising the site or redeveloping may become difficult. Short leases can be viewed as risky or an opportunity. The risk is that the tenant may leave straight away, leaving you with a vacant property. However, the opportunity is that at renewal time, they may sign a long lease. Generally, if the lease has less than 12 months remaining, fewer buyers are willing to take that risk. If this is the case, you can still look at properties with shorter leases, as part of the due diligence is calling the tenant to find out their plans and business plans. You can offer them an incentive to extend their lease or exercise the option now. Additionally, if the tenant is paying low rent, you can increase it to the market rate. So potentially, once the property settles, you have a fresh new lease plus increased rent, which means you have already added value to the investment. As you can see, both a short and a long lease have positives and negatives. For the everyday investor, it is best to focus on the property and not just the lease. The fundamentals of the property still need to stack up whether the tenant has a 2 or 10-year lease. The lease length is especially important for some businesses such as retail, where the tenant has a big fit-out cost and relies heavily on foot and road traffic, so they don't want to be kicked out at the end of the lease term. It is critical to carefully negotiate the lease terms and options, considering the local market and comparable properties. When negotiating lease terms, it all comes down to striking a balance between what the landlord wants and what the tenant requires. A tenant with a new business, for example, may want a shorter lease term with multiple renewal options, whereas the landlord will try to negotiate longer terms as this adds value to the property. So you need to come up with an agreement that is in best interest for both parties, such as a shorter lease term but at a higher rental price. Before you begin negotiating, you must understand the local market and comparable properties and what they are rented for. This will allow you to set realistic expectations and inform the tenant about other lease terms in the area and being able to provide examples. If the tenant wishes to renew the lease, the owner generally has 2 months to dispute the request. If the request is granted, new terms can be negotiated and a new rental fee may require an independent valuation. If the lease is secured through bonds and guarantees, the tenant can remain in the property while the new terms are negotiated. If the lease is unsecured, the tenant has no right of occupation after the end date on the existing lease and must vacate immediately after the existing lease expires. So, what happens when the tenant vacates? Or they want to break the lease early? When the tenant vacates a property, they must leave it clean and tidy and in the original condition without any damage. The tenant may also have to remove the fit out depending on the make good clause in the lease. The make good clause refers to how the tenant should leave the property at the end of the lease term. You want the asset to appeal to as many tenants in the marketplace as possible. If the tenant wishes to terminate the lease early, it is often possible for the property to be advertised and have the current tenant cover reasonable costs for marketing, incentives, and leasing. So, many people may think getting told the tenant wants to leave is bad. It can be advantageous as you're still receiving rent from the current tenant, but can be pickier with a new tenant and receive a new fresh lease. Of course, even in commercial, you still have a small risk that your tenant's business may fail and they do a runner or stop paying the rent. It is easy to deal with problematic tenants in commercial compared with residential, as it is deemed a business instead of a home. For example, if the tenant stops paying the rent, then you can simply go to the premises and lock the tenant out. Of course, if you have a good property manager, this is less likely to happen, and if it does, their experience will help minimize any risk or damage to the owner. Remember, a lease agreement is a legal document between you and the tenant. It is a big deal for a tenant not to pay rent, as it will chase them around town forever until it has been rectified. They won't just go and sign another lease somewhere else. They have their own business reputation that comes into play, which is why they do the right thing. If you've gone to the effort of setting up a business, building your brand, and moving into society, you won't default on the rent and then move into a new business to start again. Generally, it's not that common to have those types of tenants. Of course, some businesses will fail and some will outgrow the space and need to leave. Most of the time, you can work with your tenant to discuss options to provide a win-win situation for all the parties. In the very unlikely case your tenant does do a runner, this is where your rental bonds and guarantees come in. We'll talk more about these in the next lesson. Every now and again, there may be times when the landlord needs to evict the tenant for not following the contract. A clear and well-worded lease is extremely important, as is legally binding, and the terms of the lease bind the tenants. If they are in breach, the landlord has the right to terminate the contract and seek damages. The owner may also need to terminate the lease early if the property requires extensive reconstruction, repair, or renovation. Of course, the owner must give evidence and reasoning about why this property work needs to be done. As we know, businesses can often be expanded or sold on. A great point about commercial is that if your tenant sells their business, they generally have to guarantee the new owner will pay the rent. If the new business struggles and the rent is not paid, the previous tenant's personal guarantee remains in effect. The landlord can seek to enforce the guarantee which was given. This stops a tenant from purposely selling at a low cost to avoid any responsibility. As the lease is legally binding, it is critical to have a solicitor handle assigning the lease to the new business owner. Alright, that brings us to the end of part 1. Jump into our next lesson where we'll be continuing learning about leases. Thanks for watching, guys. See you next lesson. Welcome back for part 2 of leases. Alright, let's jump straight back into it. First, we're going to look at security bonds and guarantees. Landlords of commercial properties typically require some form of security from tenants to protect themselves in case of lease default. Security bonds and guarantees provide a monetary assurance that the tenant will comply with the lease terms. Typically, a tenant pays between 1 and 6 months' rent as a cash deposit or bond. Tenants may also provide a bank, personal, or parent company guarantee, which would be valid for the length of the lease. Let's go over the fundamentals of these types of security now. When assigning a lease, having a bond and a guarantee is preferable. A cash deposit or bond is money paid by the tenant at the beginning of the lease. Depending on the property's state or territory, you may be required to have the cash bond held by a government entity. If not, the cash bond is usually paid into the owner's or property manager's bank account. Depending on the lease, this could be a significant amount of money. So a lot of investors prefer to have the bond in their personal account, as it will enable them to put the funds into a high interest saving account. When the lease ends, you are obligated to return the cash bond to the tenant together with interest, if stipulated by the government entity or in the lease. So what's the advantage of getting a cash deposit? Well, it is simple to collect and does not require the involvement of any banks. Another option is a bank guarantee, in which the tenant's bank formally guarantees an amount of money will be paid to the landlord if the tenant fails to meet the obligations outlined in the lease. Bank guarantees are preferred among landlords for several reasons. A third party provides them, the bank is obligated to pay without first checking with the tenant, the guarantee remains in effect even if the tenant goes bankrupt. Most banks require the guarantee to have an expiry date, so always check this. If you do purchase a property, it is essential to use a solicitor to have the guarantee transferred or redrawn in your favour. You may receive a personal guarantee from the tenant's director and/or shareholder, meaning they agree to fulfil the lease's obligations if the business defaults. A personal guarantee is only as valuable as the person providing it. The guarantee may be worthless if they don't own any valuable assets. Another thing to note is there are no statutory requirements for personal guarantees, and you may need to file legal action to recover funds from the guarantor. Finally, a parent company guarantee can apply if the tenant entity is a parent or holding company subsidiary, such as a franchisee. This is preferable to a personal guarantee, but like all businesses, even the parent company could become insolvent. It could be risky if the parent company is located overseas, and enforcement of the guarantee can become complicated and costly. Let's move on to looking at the fit out of the property. A fit out is alterations to the property, such as installing fixtures and fittings. The lease agreement will specify the criteria for an initial fit out of the premises and what's expected at the end of the lease. Because fit outs can be costly to install and remove, fit out guides are often included to ensure the tenant and owner agree on what's required and expected. The fit-out quality is frequently a source of contention between the tenant and the landlord, especially if it affects the property's value. A landlord may decide to pay and own the fit-out of a property as an incentive instead of providing a rent-free period or rental concession to the new tenant. Paying for the initial fit-out allows the landlord to present a more attractive turnkey property. Regardless of whether the owner or tenant pays and owns the fit-out, this must be well detailed in the lease to help avoid disputes. With such long leases, rental increases must be built into the lease term. This is an awesome advantage of commercial property. Generally, you'll either see consumer price index or CPI increases or fixed percentage increase between 2 and 5%. The rent can be renegotiated at the end of the lease term to reflect the current market. For example, if the rents around the area have increased dramatically, you can bring your property in line with this. It is better, however, for both parties if the rent rises steadily rather than one big increase at a rent review. As the owner, it is essential to review your property's rents as this greatly impacts cash flow. There are three main methods for reviewing and increasing rents, which include consumer price index, fixed increases, and market review. Firstly, the consumer price index, or CPI, measures inflation for all Australian households and serves as a benchmark for rental increases on commercial leases. The simplest way to think about CPI is to imagine a basket of goods and services that include all items bought by Australian households. The total price of the basket will change as the prices change from one quarter to the next. The CPI measures the changes in the price of this fixed basket of items. The total basket is divided into 11 major groups, representing a specific set of commodities. These are food and non-alcoholic beverages, alcohol and tobacco, clothing and footwear, housing, furnishings, household equipment and services, health, transport, communication, recreation and culture, education, and insurance and financial services. In terms of commercial property rental increases, the rents will increase by the same percentage that all other goods and services have on average. CPI is the most accurate long-term forecasting method and an important economic indicator. The risk with using CPI-only rental increases is if the CPI turns negative, your rental growth will stagnate or fall. Next, we have fixed increases. As mentioned, fixed increases are generally between 2 and 5% per year and provide certainty to the landlord and tenant. They are generally done on the anniversary of the lease date. So if your lease started, say, on the 10th of April, then you'll get a rental increase every year on the 10th of April. It's kind of like a birthday present to you from your tenant. Sometimes over the length of the lease, the rents may become out of sync with the fair market rent. For example, if the market is hot, the fixed percentage amount set at the start of the lease might be less than what the market is willing to pay. To help get around this, it is possible to include in the lease that the increase will be the higher CPI or the fixed percentage. And lastly is the market review, which means the rent for your premises will change in keeping with the current market. This can occur during the lease term or upon the exercise of options. Once the review is complete, the lease will have either fixed CPI increases or a combination of both. The landlord generally determines the market rent during the market review, but the tenant can dispute the figure. If they do, a valuer may be called to provide a rental valuation report to determine the market rent. As an investor, if the market is increasing, regular market rent reviews will allow you to keep pace and continue increasing the rent at higher rates than a fixed review. On the flip side, if the market is decreasing, a market review could see the rental income decrease. But there is a way around this. To avoid falls in the market, some landlords will include a ratchet clause in the lease. This clause means that your rent cannot be less than the rent you were previously paying. Retail leasing laws across Australia prohibit ratchet clauses in retail leases. However, there is no such ban in other commercial leases. So, which rental increase method should you use? A lot of investors really worry about this, but the market will typically dictate the rental increases. So for most, it's a fairly minor decision. If your fixed increases far outweigh the market, your tenant will often complain and ask for rectification anyway. It is a gamble whether fixed, CPI, or a mix of both is better. Over time, we have seen low CPI, so fixed increases resulted in a better return. But in recent years, we saw a high inflationary environment, so CPI was better. So there's no right or wrong answer. You can discuss options with your property manager before signing a new lease and proceed with the method you feel most comfortable using. Let's have a look now at something called turnover rent. This is frequently used in large retail shopping centres for evaluating rent. It is a method where the rent will be calculated as a percentage of the revenue generated by the business operating from the leased premises. This is often used with a partial fixed rent or base rent amount. This allows the landlord to have greater security. If store profit increases, the tenant pays a higher amount than base rent. The retail leasing laws vary in each state and territory, so check which rules apply. The tenant will normally provide monthly audited financial statements demonstrating their turnover. Strict provisions govern how landlords can use the tenant's information. Large shopping centres commonly use this method because it gives them a helpful mix of tenants, as smaller businesses can afford the rent. This mix will result in a wider range of customers and increased foot traffic to the complex. Finally, we look at WALE, which means weighted average lease expiry. You may also hear this called WALT, or weighted average lease term. It is a valuable tool for calculating the average number of years left on the leases of a multi-tenanted commercial property. This is important for lenders to know when looking at finance. For example, if you have a property with 4 tenants, you want to know the average lease expiry, as some may be on a 3-year lease, one on a 5-year lease, and one with less than 12 months. The calculation can be done using the net lettable area or the rental income of the tenancies. The WALE gives a numeric figure and provides a snapshot of how well a multi-tenancy property performs as a whole unit instead of individual tenancies. So, how do we measure the WALE? In simple terms, WALE is calculated by taking the total length of all the leases at the property and dividing it by the number of leases. The result is the average length of time that a tenant is committed to a lease in a property. The weighting component of the calculation takes into account the relative size of each lease. So a large lease has a greater impact on the overall WALE than a small one. Don't worry, we'll run you through some numbers and have a look at an example shortly. If your property only had a single tenant, then the WALE is the number of years left on the lease. So if the tenant was halfway through a 3-year lease, you would have a WALE of 1.5 years. It is important to look at the area and rental WALE for any purchased property. A shopping centre with a large anchor tenant on a 10-year lease, for example, may have a high area WALE despite having a low rental WALE, as typically larger anchor tenant pays a lower rental rate. A lender will always look favourably on a high WALE, as it generally means a lower risk investment spread across multiple tenancies. Higher WALE properties, such as 4 or more years, are likely to have larger, established tenants willing to commit to a longer tenancy. Lower WALE properties are normally small to medium-sized businesses with shorter leases and more turnover of tenants. If you have a lower WALE, you can expect to pay higher leasing costs in agent fees, have periods of vacancy, and potentially need to provide rental incentives for new tenants. However, this can also work in your advantage if you want to upgrade the property or renegotiate lease terms. So let's look at how a WALE is actually calculated. We have a small retail strip of 4 shops in a suburban area. The total lettable area is 450 square metres and the annual gross rent received is $135,000. First, we'll calculate the area WALE, which is weighted by the tenant's lettable area against the combined area of the property. The area WALE is calculated by multiplying each tenant's area percentage by the years remaining on their tenancy and adding the figures together. Looking at the calculator, we'll be using the percentage of lettable area. So tenant 1, the supermarket, has 44.4% of the lettable area and 5 years remaining on its lease. We would multiply 44.4% or 0.444 by 5 years and get 2.22. We would do this for all 4 tenancies and add it together. As you can see from the equation, the total area WALE is 3.17 years for all 4 tenants. Now we can also calculate the rental WALE. The tenant's income is weighted against the combined income of the property. This is very similar and is calculated by multiplying each tenant's percentage of rent by the remaining lease term and adding the figures together. So for tenant 1, we would multiply the 45.9% of the annual rent, or 0.459, by the remaining 5 years on the lease, and we get 2.295. When we do this for all 4 tenancies and add them together, we get a rental WALE of 3.25 years. With area and rent WALE at more than 3 years, this is a strong investment for its size and location. While we're here, let's refresh our knowledge of yields and calculate it for this property. Remember, the yield is the net income divided by the purchase price. So looking at our equation, we have $135,000 divided by 1.875 million, and we get a strong yield of 7.2%. Let's also look at the quick cash flow calculation. We will have a 70% loan on a 5% interest rate for this example. So our interest-only repayments would be the 1.875 mil purchase price times 70% loan times 5% interest rate. This means our payments will be $65,625. Therefore, our cash flow on this property will be the net rent of $135,000 minus the repayments of $65,625, leaving us with $69,375 cash flow per year. Of course, this is a quick back of the envelope calculation and a more detailed calculation needs to be done. But we can see that this property will have a cash flow close to $70,000 a year. This shows how passive income can be generated quickly through commercial property. In this example, we have a low-risk, versatile asset split across multiple tenants where the income will only increase over time with rental increases, and that comes with good capital growth as well. The best part is we have created an easy-to-use whale calculator in the downloads for you to add to your resources. You can use this when looking at any multi-tenancy properties in the future. That brings us to the end of leases. Thanks for watching, guys, and I'll see you soon. Welcome to our next lesson, where we're going to look at commercial property outgoings. As we mentioned in Module 1, a huge advantage in commercial property is that the tenant pays for lots of your outgoings. But let's drill down further into what they are. Outgoings are expenses that a landlord incurs directly from owning a property. These costs can make a big difference to a tenant's bottom line and the owner's cash flow, so knowing who pays them is important. The outgoings are what strips the cash flow out of your pocket. In this lesson, we'll look at the most typical outgoings on a commercial property. Firstly, council rates. Council rates are property taxes to cover the cost of public or community services. These include running the council, construction and maintenance of roads, bridges, curbing, parks and gardens, and council buildings such as libraries, community activities and advertising, tree and bush management, and pest eradication. Local councils use property values to calculate how much each owner pays in rates. In other words, how much you pay will depend on the land value of your property. The council will estimate your land's unimproved value to calculate your rates. Basically, unimproved land value is the dollar figure your block of land would be worth without a building or structure. It's calculated based on the location and comparable vacant land sales. You can complain if you think your valuation is too high and needs to align with other properties in the area. However, normally councils do take a conservative approach to this land value. This is especially important if you are over the land tax threshold in that state, as the higher the value, the more tax you'll have to pay. More on land tax coming up next. Council rates are generally paid in advance in quarterly instalments. Some councils offer discounts for early payment, so it's worth checking this. Exemptions from rates can apply to some properties such as crown land, land used for religious purposes, charitable land, and mining or forestry. Now, let's look at land tax. This state-based tax applies to investment properties in your portfolio, excluding your principal place of residence or PPOR. It applies when the total taxable value of the unimproved land you own is above the threshold for the Australian state or territory that you're located in. There are different thresholds for personal and company ownership structures, which are reviewed yearly in each state. Land tax doesn't just apply to commercial properties. It also applies to other investment properties such as residential property and vacant land. Land tax applies regardless of whether income is earned from the land. It is best to talk to your accountant so you understand the thresholds that apply to you and any potential tax you may pay. For example, this table shows the land tax thresholds applied in 2021 to 2022 financial year. Let's say you owned a single commercial investment property with an unimproved land value of $500,000. If the property were in Victoria, you would pay land tax as the threshold is $300,000. So you would pay a percentage of the tax on the amount you are over. So in this case, $200,000. But if the property were in New South Wales, you wouldn't pay any land tax as their threshold is $822,000. Some investors take this into account when considering what location to purchase in and will choose some states over the others. Property management. A real estate property manager charges property management fees for managing the property. We'll go into detail on all things property management in Module 9. Next, we have water and utility rates. Water rates are paid to the authority that provides water and sewage services to your property. The rates are paid quarterly in arrears and have two components: a fixed amount for providing the water mains to the property and a variable amount based on your water usage. There's usually no discount for early payment. Utility rates include electricity and gas, and they're usually separately metered. If the building has common areas that require electricity for lighting, a communal driveway for example, the strata manager will have a separate contract with the electricity provider. These fees are usually passed on to the tenant through the body corporate. There can be quite a cost variation among utility companies, so it's best to shop around. Most will offer a discount if you sign a longer agreement too. The tenant is usually responsible for the water and utility rates. Body corporate fees. A body corporate is an entity that manages the common property of a building or complex. They are sometimes also referred to as owners' corporations or strata corporations. The management entity charges body corporate fees and covers everything from building insurance and maintaining common areas to shared utilities, building works and repairs. Body corporate fees are only applicable if your property is not a freehold and is part of a strata. Each year, the owners contribute funds that form the body corporate or strata committee budget. The budget is generally divided into two categories: an administrative fund, which mainly covers day-to-day expenses, and a sinking fund, which pays for emergencies, capital works, and irregular large-scale works. Sometimes a special levy is required if unexpected costs weren't considered when the administrative and sinking fund budgets were set. Body corporate fees are calculated by adding the total amount required to maintain and manage the building each year and dividing that among the owners depending on their proportion of ownership. The fees are agreed on at the annual general meeting or AGM in which all owners in the building can vote. Next up, we have insurance fees. Insurance protects the owner's assets should something unexpected happen. There are three main insurance required for commercial property, and they are building insurance, landlord insurance, and public liability insurance. Building insurance covers the physical building against damage. The property should be insured for as many items as apply to your area, including, for example, fire, flood, storm, earthquake, hail, bushfire, and third-party damage. If the property is freestanding, i.e. not attached to another building, it's imperative that you have building insurance. Most lenders will require you to have it before they'll give you finance anyway. If the property is strata titled, the body corporate will hold the building insurance for the common areas of the property. However, it's best to check what the body corporate insurance covers. The tenant isn't always responsible for the building insurance, so it's important to check what's stipulated in the lease. The tenant or occupier is responsible for insuring the contents in strata buildings. Landlord insurance will cover the owner's loss of rent should the property become uninhabitable after damage caused by a natural disaster. Rent cover isn't usually the tenant's responsibility, so it's up to you as the owner whether you take this out or not. The decision will usually come down to your financial position, risk profile, and the risk on the property itself. Public liability insurance protects the owner from being sued if someone is injured on the property. Most tenants will have this, but check. The owner rarely pays for public liability insurance unless they are responsible for common areas. Next, we have some outgoings that are less talked about, but important to understand for any commercial property. Maintenance costs. All property types will require general maintenance. Tenants are usually responsible for maintenance inside their premises, but the complex will be looked after by the owner or the body corporate. Maintenance costs are often left out of real estate agents' presentations because they are usually for one-off items such as repainting the building. The tenants will normally be required to maintain and repair the property, but not to make large capital expenditures such as replacing an air conditioning unit. It's important to stipulate the tenant's responsibility for maintenance in the lease and ensure that your property manager has communicated this to the tenants and they understand clearly. This will help cover you if they fail to fulfill their maintenance duties, as the costs for replacement can be passed on to them. Gardening and landscaping depend heavily on the individual property and can range from a small, low-cost feature to a large, extensive maintenance item. Before buying a property, it's worth obtaining the gardener's details to determine how much work is required and whether any costs are coming up, such as tree removals or garden upgrades. Cleaning. Cleaning of the tenant's premises and the shop front is, of course, the tenant's responsibility. Many multi-tenanted commercial properties have third-party cleaner for common areas, including walkways, washrooms, rubbish bins, lawns, yards, and car park areas. When an investor buys a property, a cleaner will already be servicing the premises. Find out the details of the cleaner's contract, such as the frequency of cleans, the length of time, and the cost. If you feel there are cheaper options, it's worth bringing this up in the next body corporate meeting. Getting the best value for money deal for cleaning can reduce the outgoings for the tenant or owner. Fire inspections. Your commercial property must comply with the latest fire regulations. Most governing bodies and councils will require an annual, biannual, or quarterly inspection depending on your commercial property type, and penalties can apply if these aren't performed under the code. Fire inspections are conducted by a third-party company, including inspection of evacuation plans, exit signs, smoke detectors, extinguishers, fire hoses, fire hydrants, fire doors, and building cladding compliance. An annual fire compliance certificate is provided that needs to be kept and recorded. If the property has a strategy manager, they will usually organise this. Fire safety has become a big focus since the Grenfell Tower fire in London in 2017. The fire was caused by a faulty fridge, but it was an issue with the building regulations that allowed combustible cladding to be used. Buildings with this cladding are now pretty much uninsurable for public liability coverage and can have orders for expensive removal and refit with safer material. This has prompted bans on many materials and tighter building regulations, so it's essential to check this before buying. Backflow prevention testing. Backflow prevention devices are fitted to water pipes to prevent the reverse flow of potentially polluted water from a property back into the main supply. Some devices require testing by a licensed company. The local council will outline how often your backflow devices must be tested, usually yearly. As with fire inspections, there are penalties for non-compliance. Rubbish removal. For most commercial premises, excluding mixed-zone residential properties, the council does not provide rubbish removal. If there is one, it's usually organised by the tenant or the building strata manager. Rubbish removal can cause arguments amongst tenants as different businesses produce differing amounts of waste. As an owner, you'll need to monitor how much rubbish is removed and how often to ensure you're not paying for a service that's not required. While we've covered a range of outgoings, they may not all apply to your investment property. It's important to know each of them and how they may affect your investment or cash flow from the property. Thanks for watching, guys. Welcome to your next lesson of the module, where we cover depreciation. Depreciation is a concept that is often discussed about with property. So what is it? Well, it's basically the loss in a property's value over time due to the aging and wear and tear. When it comes to commercial properties, you can enjoy significant tax benefits and depreciation advantages. While owners of residential property can also claim depreciation, the benefits are usually higher for commercial buildings. Commercial properties are typically larger and have more expensive construction and interior fittings. For instance, a concrete office building will experience greater depreciation than a timber residential home due to high cost of materials and construction. When it comes to claiming depreciation, commercial property owners can deduct the decrease in value of the building structure and the decline in value of any assets they own within the property. On the other hand, commercial tenants can claim deductions for any decrease in value of any assets they purchased or installed during the fit-out process. It's important to note that the land itself cannot be written off and the cost of the land is not tax deductible. Only the building structure and the eligible assets within the property can be claimed for depreciation purposes. Let's look at how we can calculate depreciation deductions for a property. These can be broken down for the building structure, known as capital works, and for plant and equipment. Let's go deeper into these. Capital works refers to the building structure and any items considered permanently fixed to the property, including the building itself and any structural improvements. Capital works can be written off over a longer period than other depreciating assets. In Australia, the capital works deductions are available for buildings or extensions, alterations or improvements to the building, alterations and improvements to leased buildings, including shop fit-outs and leasehold improvements, structural improvements such as sealed driveways, fences and retaining walls, and earthworks for environmental protection such as embankments. If you cannot determine the actual construction costs, you can get an estimate from a quantity surveyor or other independent qualified person. You then can claim a deduction for the full estimate from the year the cost was incurred. The deduction rates for claiming tax benefits on construction expenses depend on factors such as the construction start date, the type of capital works, and their purpose. Generally, there are two deduction rates, 2.5% or 4%. It is important to mention that investors who purchase commercial properties constructed before certain threshold dates can still claim capital work deductions for any renovations made to the property. Even if the property was built earlier, there may still be opportunities to benefit from tax deductions for improvements and upgrades. Plant and equipment are assets that the Australian Taxation Office deems easily removable or mechanical. These include air conditioners, refrigeration, ovens, fans, carpets, etc. The depreciation of assets within a building is calculated individually in accordance with each asset's value and longevity, which is determined by the ATO each year and is referred to as the asset's effective life. Commercial investors can claim depreciation on any assets they own within the property, but not on anything the tenant has installed as part of their fit-out. If the asset is worth less than $300, you can claim an immediate deduction in the income year you bought it. If not, you can use one of two methods to calculate the asset's annual depreciation. The diminishing value method gives you higher claims in the first few years and smaller claims later on, as the value of most items reduce this way. This is the one most investors choose as it's more money in your pocket now. The prime cost method gives you equal tax deductions each year over the course of an asset's effective life. The prime cost method is also called straight line depreciation and gives you a yearly average. When you buy a property, it's a good idea to engage a quantity surveyor to create a tax depreciation schedule, or TDS, shortly after settlement. This schedule is important because it allows the surveyor to evaluate the property in the exact condition you purchased it, ensuring the most precise depreciation estimates. The schedule will provide a detailed breakdown of each item in your property and assign a specific depreciation percentage to them. This schedule will give you a clear understanding of how much each item depreciates over time for tax purposes. It's a valuable document that can help you maximize your tax benefits and accurately track the depreciation of your property. You only need to have the schedule completed once for the property, but make sure to review it and update your depreciation schedule if you do any significant renovations to the property. Then, come tax time, you'll give this report to your accountant and choose which of the two methods you will use. So, which method is better? Well, that depends on your circumstances, but most investors will choose the diminishing value method as mentioned previously. Do you want to see what a depreciation report looks like and compare the methods? Well, you're in luck. Have a look in the download section where we've included an example report for both methods. When considering whether to buy a property, ask the selling agent for the previous owner's depreciation schedule. This will give you an accurate indication of the added cash flow from depreciation. It's worth noting here though, that you should never buy a property based solely on the tax benefits. The fundamentals of the purchase need to be sound. Thanks for watching, guys. Welcome to your next lesson, guys, where we'll be introducing the concept of capitalization rate and how this impacts property value. So let's jump into it. Capitalization rate, or cap rate, is a concept used to determine a property's market value at that moment in time. It is used in the context of buying and selling property. Cap rate is one of the most misunderstood terms in commercial property, but we'll try to break it down for you now. Generally, the cap rate is calculated as the ratio between the asset's net operating income, or NOI, and the original purchase price. For example, if you purchase a $1 million property and it returns $50,000 in net rent per year, it would have a cap rate of 5%. Cap rates differ from your return on investment as they are based solely on the net operating income and purchase price, and don't consider your mortgage repayments or purchasing costs. A cap rate helps you to directly compare with other properties and allows you to compare the relative value of similar commercial properties. It does not allow you to compare differing types of commercial properties, such as office space versus industrial warehouses. But it is a helpful back-of-the-envelope way to look at like-for-like properties. As always though, further due diligence and analysis should be performed when considering actually pulling the trigger on a property. Cap rate and net yield are essentially the same thing and are often interchangeable. The difference is that the term net yield is used for the net return of a property, whereas investors tend to use the term cap rate to compare the value of similar commercial properties using their rental yields. Using a cap rate is a high-level way of comparing properties that help when talking to agents and looking at properties in the same location. As much as the cap rate is a measure of return, it essentially indicates the risk involved with the property. The higher the cap rate, normally the higher the perceived risk. For example, if you were to purchase an industrial warehouse in rural Queensland, like Mount Isa, you might be demanding an 8% cap rate. If that property and tenancy were the same and you picked it up and moved it into a capital city like Brisbane or Sydney, you might be asking for a 5% cap rate. If all things on the property are the same, the property's geographical location determines the risk and the return that the investor has to receive to take on that risk to go into the market. Cap rates in capital cities are generally lower as people believe these to be safer to invest in, are a more solid location, and have lower vacancies than regional towns. The cap rate helps removing the guesswork from buying and valuing properties. You can use a cap rate to calculate the value of a property. Let's look at an example. Say you are looking at an advertised property that doesn't have a price guide. The agent advises that the net rent is $70,000 per year and the cap rate of the area asset is around 7%. You can calculate the $70,000 divided by 0.07 or 7% and land on $1 million. This means the property's purchase price should be around that mark. Let's pretend that the cap rate was actually 6%. This means you would divide the $70,000 by 0.06 or 6% and the purchase price would now be around the 1.16 million range. Along with the asset class and the location, cap rates are also influenced by the lending environment and the cost of borrowing. Lower or higher interest rates will directly affect cash flow and influence a property's cap rate over time. Next lesson, we'll look at a spreadsheet that will allow you to play around with these numbers to determine your return. So, how exactly do you find out the cap rate of a property? There are a couple ways to find out the cap rate, including asking the property manager. A selling agent or property manager who knows the area well will be able to give you a quick rundown on cap rates. It is best to speak to an agent who isn't involved in the sale, as they are more likely to give you unbiased information. Checking sold prices. You can check recent sales history of similar properties and find out what they are renting for to compare. Checking what else is for sale. Some agents will advertise the property based on the net yield or even mention cap rate. Speaking with a local valuer. A local valuer is a great independent source whose job is checking cap rates to accurately value properties. You should get the best information from all 4 sources in the list and find comparable properties of the same type and in the same location. You'll find a lot of online properties that won't give you a price indication, so it's up to you to use this information to negotiate a price. So, why do some properties have lower cap rates? Low cap rates indicate stable tenants, such as national franchises, high foot traffic, and solid locations, as these are considered lower risk or higher capital growth areas. If the property is freestanding and has good land value, this can also reduce the cap rate. Okay, so what makes a property have a higher cap rate? Higher cap rates indicate high vacancy periods, regional or quiet areas, poor quality tenants, or a dying industry tenant. In other words, the higher the cap rate, the higher the risk of investing in that commercial property. Whilst these properties can appear attractive from a numbers perspective, once you consider longer vacancies, leasing fees, marketing costs, incentives, and lower capital growth, their net result is usually less. However, please note these are just general rules of thumb. You can get lower risk properties in regional areas that do have high cap rates, but you need to understand what you're doing and how to analyze it carefully. Let's move on to property valuation. There are so many types of commercial property, so determining a property value is a lot more difficult than residential. There are 3 main methods that commercial property investors use to value properties: income, comparable sales, replacement cost. Let's take a look at each of these now. Income method. This is the most commonly used method by investors whose sole focus is cash flow. The property's net income can be calculated once the data and numbers are obtained and verified, specifically income and outgoings. The cap rate can then be calculated and compared with the market. This will give the investor a good indication of the property's value, assuming the tenant is paying fair market rent. Comparable sales method. The comparable sales method uses recent sales to estimate a property's value using comparable properties. The usual time frame is the past 6 months, however it can be longer if it's a regional area or there's been no big changes in cap rate. As it can be tricky to find properties yourself, you can pay a valuer to assist you and do a short form valuation, which they'll inspect the property and compare it to recent sales in the area. This method is the most common with business owners looking for a vacant commercial space, as they are less interested in the cap rate and rental returns. Replacement cost method. This method is mainly used as a backup verification and for newer properties. You will determine the land value first and then the cost to replace the building. This is easier to quantify for new buildings, as the depreciation for older buildings must be considered. With this method, the strength of the lease and cap rate are not considered. The formula for the replacement cost method is as follows. The estimated value, which equals the land value plus the building costs minus depreciation. Finally, let's look at vacant properties. Valuing a vacant property can be more difficult than valuing one already occupied. You'll need to research first to determine how much rent the property could fetch. This involves comparing it to similar sized properties already occupied and calculating a rate per square metre. You can then apply this figure to the floor space of the vacant property to estimate the rental value, and then use the income method. You'll also need to consider how long it might take to find a tenant, which involves talking to local real estate agents and property managers to understand the rental market. It's wise to be conservative here, as rent and vacancy rates can vary depending on the time of year and other external factors. Lastly, you'll need to factor in costs associated with renovating the property to make it more attractive to potential tenants. You may also need to offer incentives to new tenants to get them to sign a lease. And that's another one done, guys. See you next lesson.
Hey guys, welcome to the explainer video for the 10-year projection showing cap rate changes. The purpose of this spreadsheet is to show what happens to a property value should the cap rates compress or expand, because as we've discussed, generally the value of the property is in line with the cap rates. So if we see a tightening of cap rates, we get capital growth. If we see a loosening of the cap rates, we actually lose value of the commercial property. So this spreadsheet is a really good way just to get an idea of over 10 years' time, how different cap rate changes will affect its outcome. Similar to other spreadsheets, any of the cells that are in orange you can change, such as the purchase price, the deposit, the net yield, the rental increases, the loan interest rates, and the expected depreciation on the property. We'll keep these figures the same for now, and we'll have a look at what actually happens. If you actually change the net yield, basically what I've done is I've looked at a 0.5% change in cap rate based on what the net yield is. So if we went 7%, you'll see that it changes what happens if it goes to a 7.5% cap rate or if it drops to a 6.5% cap rate. So we can change these numbers, and same as look at the different rental increases and loan rates and how it'll actually change the outcomes. I know this spreadsheet is a little bit heavy, but stick with it because there is some value and it actually shows the true worth of commercial properties and how to grow a portfolio. So let's just go back to 6% net yield and have a look at some of the numbers. So for this, on a 70% loan, so i.e. 30% deposit, a $700 loan amount, you've got loan interest of $35,000. So that's your outgoing per year. It's interest only. We're not paying off any of the debt. We've just got a $35,000 outgoing for the property. And with commercial, the tenants look after all the other outgoings. So in this scenario, let's assume that the same tenant's there the whole time. If there is any additional outgoings, you can put them here and that'll transform across the 10 years. But in this scenario, let's look at like the zero outgoings. So $35,000 a year interest only repayments. The first year, you're going to get $60,000 net rent plus $3,000 depreciation, which works out being a cash flow of $28,000 per year. Where this forecast is year after year after year, the rental increases at 3% actually increase the cash flow because that $60,000 is actually increasing by 3% per year. So you can actually see in 10 years' time, the $28,000 is no longer $28,000. It's actually $46,000 per year. And if we saw more rental increases, for instance, like we had a really good few years of 7%, then it becomes $78,000. So we can play with those numbers to see what the cash flow might look like in, say, 10 years' time or 5 years if you want to look up. But at 3 years there. Now what we look at is what happens if we see some compression. So we buy in a really good capital growth area and the cap rates drop from 6% to say 5.5%. The value of the $1 million property that was $1 million at a 5.5% cap rate would actually become $1,090,000. So we're making $90,000 just from the cap rate compressing. You can watch some of my other videos and I'll explain what changes cap rates, but generally there's a lot to it, such as the economy, interest rates, inflation, rental increases, the economics of the area, what infrastructure is going in, supply versus demand, population growth and things like that. But this is mainly just to explain the spreadsheet. If, for instance, the area is not as attractive anymore and it goes the other way, so there's a bit of an undersupply or something happens in the economy that actually means there's more vacancy, the cap rate might actually go to 6.5%. So similarly, we actually lose circa $80,000 the other way. But where I want to show this is you can make money just from buying in a good capital growth there, which is quite a lot of money considering you're 28,000 yet. Within just a cap rate conversion, you can make a few years worth of cash flow. Now what actually happens, over the 10 years, you can actually see this figure actually changes. So we're looking at a current 6%, the 3% capital growth, the property is then worth $1.3 million. If we had, say, 5% capital growth, that property would be worth $1.5 million in 10 years' time. If it's 10% capital growth year on year, this is where it becomes really powerful and why I encourage investors to not only just chase cash flow, chase capital growth, because if you can get 10% capital growth year on year, in 10 years' time, your $1 million property is worth $2.3 million. So that's quite powerful. So if you can get the best balance between cash flow and capital growth, your return on investment will be much more in the grand scheme of things. Now let's go back to 3% rental increases. Now the next section looks at what your return is if you actually take into account some compression, and that adds basically the cash flow plus the capital growth that you would have received. So in this instance where you're getting $28,000 a year cash flow, if it compressed, you'd actually have $118,000, which is the $90,000 plus the $28,000. And again, this shows if you're buying a really kind of tightly held area, you can win on both fronts and make really good money. Now let's look at the next section, which is what happens if we actually pay down the debt with that $28,000 cash flow that we're actually receiving. You can see the debt then becomes $672,000 because we've paid off the $28,000, which would in turn then increase the cash flow per year because there's less interest repayments. So forecasting 10 years, you can actually see the cash flow goes up as the debt goes down. And within 10 years, that $700,000 debt, even with these assumptions that are very conservative, is $247,000. And we're then left with a $65,000 passive income. So that's very powerful considering we're just buying a 6% net yield with 3% rental increases and a 5% interest rate, that we can have a $65,000 passive income with $250,000 debt on the property. That is really powerful because basically a residential investor will tell you that commercial is too high risk, but I'd argue if you can get your debt down to something like this in 10 years' time and have a passive income, a lot has to go wrong. Like interest rates would have to skyrocket. You have to have a huge period of vacancy before you start dipping into your own pocket. But anyway, have a bit of a play with this spreadsheet. If you've got any questions, feel free to reach out. I'd love to help. Cheers.
Welcome to your next lesson where we're looking at the very important concept of cash flow. This is where things get really exciting. Cash flow for commercial property is essential and a key consideration that investors look at. Put simply, cash flow is the income the property produces after all expenses. The income can include both the rental income and any tax depreciation benefits. Expenses for commercial are primarily mortgage repayments, but can also include other outgoings such as property management fees. Think of the equation as this. Cash flow equals the net income plus tax depreciation minus mortgage repayments minus all other owner expenses. As we looked at in Module 1, one of the main reasons investors look at commercial is the high cash flow. This allows them to service the loan while expanding their portfolio much more easily. Let's look at an example to see how to calculate cash flow using our cash flow calculator easily. You will find the Excel spreadsheet in the download section. In our example, we are purchasing a commercial property for $1 million. The net rent of the property is $60,000, so a 6% net yield. We include $3,000 for tax depreciation, so our total income will be $63,000. We have a rental management fee of 4% for our expenses, which is $2,400 a year. Plus, we have interest-only repayments. For a 70% LVR on a 5% interest-only loan, the repayments are $35,000 a year. So this brings our total expenses to $37,400, which you can see these in red. Remember, with commercial property, the tenant pays your outgoings, such as council rates, water rates, and maintenance. So our cash flow will be the rent, plus the depreciation benefit, minus your interest, and minus the rental management, resulting in $25,600 cash flow each year. That's positive cash flow. Over 25 grand a year in your pocket. Welcome to commercial property. How good is that cash flow? Imagine if you had 4 of these commercial properties. That's $100,000 passive income yearly with a $4 million worth of property. That's instant retirement for many when you hit those kinds of numbers. You would need to buy a lot of residential properties and pay off a lot of it to get it even close to that number. There are lots of people that have a residential portfolios of $4 million that are spread over several houses and are only slightly positively geared. But with increased interest rates or unexpected maintenance, suddenly they are neutral and even negative. But commercial property is risky and you can have long vacancies. This is what many argue about commercial property. Whilst this is true to a certain degree, you can mitigate the risk. Let's look at the numbers. Let's pretend that our tenant left after 2 years and we now have a vacant property. While it can hurt to not have a tenant and pay all the expenses yourself, with the $25,600 a year cash flow we received for both years, not even taking into account rental increases, you are up by $50,000. So even if the property is vacant for a full year, you can easily service the $35,000 repayments and expenses with your accumulated cash flow without having to dip into your own pocket. You can see even without the depreciation benefit, or if you've borrowed 80% LVR instead, the property is still extremely cash flow positive. Another perceived risk to your commercial return is rising interest rates. I often hear a statement from people, you'll be in trouble if the interest rates go up. So what happens if the interest rates go up? Well, let's have a look at the numbers. If interest rates went up to 7%, guess what? Still cash flow positive. For a 70% LVR on a 7% interest-only loan, the repayments will bump up to $49,000 a year. So this brings our total expenses to $51,400. Our cash flow is still $11,600 a year positive. Again, even with an 80% LVR, the cash flow is still positive. This is one of the huge benefits of commercial property and why many investors are moving towards commercial, the cash flow. Sometimes commercial property is lower risk than residential because even with rising interest rates, you still have a good cash flow buffer before you start having to dip into your own money. In saying that though, you have to get it right, meaning having a solid tenant in a good location with very low vacancies. Another way to increase your cash flow is if you decide to pay down the debt. As you can see from the table, when paying down a property, the yearly cash flow will increase as the interest repayments reduce each year. The original $1 million property had a $700,000 loan in this example. After the first year, the $25,000 cash flow has been put straight back into the loan, meaning it is now $675,000. We now pay smaller interest repayments with the reduced debt, and our cash flow has improved. In addition, we are receiving 3% rental increases each year, which will also help improve the cash flow. It is worth noting, however, that whilst the cash flow is very strong, a higher deposit is required for commercial property, which would affect the return on investment. Now that we've introduced cash flow, our next lesson will be a further in-depth look at cash flow and the difference between making interest-only repayments or principal and interest repayments. We will also be looking at how to stress test our portfolios. Thanks for watching, guys, and see you next lesson.
Today we're going to look at the commercial property cash flow calculator and how to use this Excel spreadsheet. The main purpose of this spreadsheet is to work out what the cash flow looks like on any particular commercial property. And the main benefit of this is you can look at whether you're on an interest-only loan or a principal and interest-only loan, as well at varying different interest rates. So you can get an idea if, say, interest rates are higher, what your cash flow might look like, or if interest rates come down, how positively geared the commercial property may be. To use this spreadsheet, you can actually change anything that's in orange cells. So the purchase price, the gross rent, the depreciation, the rental management, the outgoings if they're not paid by the tenant or any additional outgoings you have, and the loan term if you're worried about a principal and interest repayment method. So let's just have a look. Let's stick with $1 million purchase price because it's a nice even number that you can double in price or halve in price just to get a bit of a gut feel for what the commercial property might look like at different yields. The gross rent is what you get from the tenant and not considering the outgoings. As we all know with commercial property investing, normally the net rent is what you get from the tenant because they look at things like council rates and water rates and things like that. So consider $60,000 on $1 million purchase, you're a 6% net yield. But let's say, for instance, you got a gross lease where the tenants didn't pay the outgoing. So say you got $65,000 from the tenant, but you had $5,000 worth of outgoings per year, such as council rates, water rates, and things like that. You can see that the net yield is then still 6%. So let's just pretend we got a 6% net yield and it was a net lease, so the tenant looked after all the outgoings. The depreciation is what you get back at tax time after Mr. Accountant does all his magic. On newer properties, that might be a $5,000 to $10,000 figure for $1 million purchase. On a 30-year-old property, it might be zero, for instance. The rental management is the percentage fee that the property manager will take for managing your property. This is generally between kind of 2% and 7%, depending on the purchase price and the rent that received from the tenant. Let's just leave it at 4%. And then the typical loan term is, say, 30 years. Normally, commercial loan terms are a little bit less. We're talking 15, 20 years, but I'll leave it as 30 because later on I want to have a look at kind of residential and compare the two, which is another spreadsheet later on. Now, let's see the inner workings of the actual spreadsheet. Now, let's have a look at the first line of cash buying. This is if you went up and bought the $1 million commercial property with zero loans on the property, so paid it in cash. So you'd generally be receiving $60,000 rent and then getting $3,000 back at tax time. Because you don't have any mortgage repayments, there's zero repayments to be with the lenders. Let's look at the first line, cash buy. This is if you were buying the commercial property cash and you did not have any debt on the property, i.e. you're not going to have any interest repayments or mortgage repayments on the property. So you'll see for this case scenario, you'd have $60,000 net rent from the tenant and get about $3,000 tax back at tax time. Because we don't have any mortgage, there's no principal and interest repayments or interest-only repayments, you'll still have rental management. Because this is a net lease, you don't have any outgoings because the tenant's paying. So the cash return for both scenarios, interest-only and principal and interest, because there is no debt on it, is the rent plus the depreciation minus any outgoings. So the only outgoing on this one is $2,400. So it's basically the $63,000 rent minus $2,400, which equates to $60,600. Now let's have a look at a 70% loan on the property, i.e. you'd be paying a $300,000 deposit on this property. An aggressive investor will typically go for 70% loans or 80% loans if they can get it, or potentially be looking at remortgaging another property, and this is where the 100 and 105% loans come in. So for a 70% loan, this would be a $300,000 deposit for $1 million property. Now what happens is we're still getting the same $60,000 rent and the $3,000 back at tax time. However, we have interest-only repayments on the property. So we're going to have $24,500 interest-only repayments. This is calculated from basically looking at a $700,000 debt and timesing it by the interest rate. So in this scenario, it's 3.5%. And that equates to $24,500. Let's ignore the principal and interest repayments for now and do it for the interest-only case. You're still going to have rental management as before, and there's zero outgoings because it's a net lease. The way this number is calculated, which is the cash return for interest-only, is done by adding the $60,000 plus the $3,000 minus the $24,500 interest-only repayments minus the $2,400 rental management, which equates to $36,100 cash flow positive. Now, similarly, if you're actually looking at principal and interest repayments over a 30-year loan type, you'd actually have $37,720 per year repayments. So this would be coming off the $60,000 plus the $3,000 versus the $24,000 that you looked at interest only. So you can see instead of having a $36,100 cash flow positive return, you've got a $22,000, $880 return. Similarly, if you actually look at 80% loan or 100% or 105%, the 105% is used when you're using 5% for purchasing costs. So you're pulling equity from another property, but you're using to pay things such as stamp duty, which is around 3.5%, legal costs or a buyer's agent cost. It's just a nice conservative figure to look at. Okay, if I'm 100% debt and I'm including the purchasing costs, what the cash flow will look like. And you can actually see, like, when you do a 105% loan versus a 70% loan, the cash flow is quite different. We're down to $4,000 per year cash flow positive. Now, most people at this time of viewing, you're not going to see 3.5% interest rates. You're more likely going to see 5 or 6 or potentially 8%. So we've actually looked at varying interest rates to see what would actually happen to the cash flow. You can see here, so for a 6% net return, different interest rates and different loan values, basically the cash flow on an interest only starts to really turn red, which is a negative cash flow, at around the 6.5% interest rates. Obviously, if you're 100% debt or 105% debt, it's going to be slightly negative. But that's still quite a strong outcome, because having a property that's only 4 or 5 grand a year negative and using zero of your own money, leveraging the banks completely, that you can hold that through quite a lot of kind of risk profiling. So this is the power of commercial property. Even at high interest rates, the properties are quite manageable. And that's even say we go up to 8.5% interest rates. On a 70% loan, you're still cash flow positive. So if you compare this with a residential, you're going to be very, very negative at 8.5. Like on $1 million property, probably $30,000, $40,000 a year negative, which we'll go into in another video. So check out the comparison between residential and commercial spreadsheet. But even at a 105% loan on an 8.5% interest rate, you're 28 grand a year negative. That's still very manageable for some people. If you've got 2 income earners on $150,000 a year and you're not over leveraging out the portfolio, you could probably handle a few of these commercial properties being that for some time and weather the storm while interest rates drop or say rental increases happen. But this spreadsheet is the first thing I'd actually use when you're just looking at a property, bit of a back of the envelope check to say, okay, what does the cash flow look like on this commercial property that I'm looking at? And can I stress test it? Am I happy with the stress testing? And then you may progress to more detailed due diligence. If you've got any questions about this spreadsheet, please reach out and ask questions. I'd be more than happy to help. Thanks for watching, guys. Hey guys, welcome to the explainer video of the interest rate stress test and cash flow calculator. This is actually my favorite spreadsheet because it actually does everything. It lets you stress test your portfolio, look at what your cash flow is for different interest rates, whether it be interest only or principal and interest. It does absolutely everything. So let's go through and have a look at what you can actually change and what the outputs are. As always, anything in orange can be changed. So the orange cell is basically the purchase price, the net rent, the depreciation, the outgoings, any capital gains you want to forecast, the rental management, as well as the loan details such as interest rate, occupancy. So that's if you want to stress test, say you had only 50% occupancy on the property that year, the loan to value ratio, and whether you want interest only or principal and interest. So let's just go through. You can change basically, let's just say, or a 6.5% net return. They'd put $65,000 in there, but let's stick with $60,000 net rent. Press recalculate whenever you change any of these and it'll automatically calculate for the new values. For this scenario where we've got a $1 million purchase and a $60,000 net rent with $3,000 depreciation, no outgoings because it's a net lease, 5% capital growth, 4% rental management fees, 5% interest rate, 100% occupancy for the year, and a 70% loan to value ratio on an interest only loan. What I like about this quick cash flow lookup table here on the right is you can actually see at different interest rates what the cash flow looks like. So you can see we've done the scenario at 5% interest rate where it's $24,000 a year. However, if say interest rates went up to 8%, it'd still be positive, $3,400 a year. And this is one of the other advantages of commercial property. Even at high interest rates, you can weather these storms quite well when compared with residential. But if we go for this scenario, all the numbers here on the left. So the commercial property cash flow output would have the $25,600 at a 5% interest rate. This is taking into account depreciation. And then if you look at the total return, this is basically what happens if we get 5% capital growth as well. So it's going to be the 5% capital growth, which is $50,000, plus the $25,000 cash flow. We're looking at around $75,000 a year return on that purchase, which is actually quite positive because that almost equates to someone's salary when you look at average Sydney salaries, for instance. And what I also like about this is I actually calculate when the break-even interest rate is. So when you have to start dipping into your own pocket. So you can see in this scenario, it's 8.66% before the property goes cash flow neutral. And you can see this quite quickly here if you look on the right, where 8 to 9% is where it does the turn, but the exact figure is 8.66. The other thing we can look at is, okay, let's run this same scenario in a principal plus interest kind of arrangement. You can change the loan term up here. So if you want 20-year loan term or 30-year term, so that yellow one you can actually change. But let's just say the interest rates were 5.5% in this scenario. I'll click recalculate to make sure it all happens correctly. And then you can actually see the interest rate where it becomes negative is actually a bit lower. Previously, it was around 8.5%. Now we're actually at 7.34%. So that extra repayments does change the cash flow. And this spreadsheet can be used when you're deciding whether you go interest only or principal and interest based on your risk profile. But this spreadsheet you definitely need to use when you're stress testing your portfolio, looking at the difference between principal and interest, as well as changing the loan terms and looking at just generally your overall health of that property that you're looking at. If you've got any questions about this spreadsheet, please reach out. More than happy to help. Thanks for watching, guys.
Welcome to your next lesson on numbers, where we're looking at return on investment. Return on investment, or ROI, is a measure used to determine the efficiency of an investment. It also allows you to compare efficiency across several investments by measuring the returns compared to the costs. You may have heard this mentioned as cash-on-cash return, but ROI also considers capital growth of the investment. To calculate the ROI, the return on investment is divided by the cost of the investment and expressed as a ratio. Let's have a look at some numbers now. In the downloads, you will find a return on investment calculator that will allow you to see the efficiency of your investment. Let's take a look at the calculator and show our example. Again, a $1 million property was purchased with a 30% deposit. We receive a 6% annual rental yield, or $60,000 net rent. We've included a very achievable $3,000 tax depreciation benefit, and our interest-only repayments are based on a 5% interest rate. Remember, you can change any of the orange fields to better represent your scenario. Based on the calculations, our return on the investment is $28,000 a year cash flow. We then need to divide that by our costs, cash we contributed, or total acquisition costs. So $28,000 divided by $337,000 equals 8.31%. This is our cash-on-cash ROI, as we have not factored in any capital growth. If we were to also have 5% capital growth, then you can see our overall ROI is 23.15%. Keep this calculator handy for any future purchases to easily calculate the ROI for a potential property. Interest rate fluctuations and different loan-to-value ratios, or LVRs, will influence your ROI. Let's look at how different LVRs and interest rates affect our return. In this table, we have the same $1 million purchase. The LVR will change depending on if you're paying cash, a larger deposit, or leverage against another property. It is possible to have 100% LVR, which means to borrow the full 100% of the purchase price if you use another property's equity to finance the purchase as a deposit. In this example, for 100% LVR, we have borrowed the full $1 million and will only be paying the $37,000 acquisition cost from our own pocket. You can see that at a lower interest rate of 5%, borrowing more, especially the full 100%, allows you to maximize the ROI from cash flow. However, being highly leveraged has risks. If interest rates are to rise, we can see at 7.5%, the ROI becomes negative. If the property were to become vacant, there could be a financial stress on the owner, having to cover the interest and expenses during this time. Higher LVRs also run the risk if the market drops, as the owner will be in a negative equity position. This table shows us the pre-tax ROI using cash flow for a year. But as mentioned, property investment is a long-term game and we will have experienced rental increases and capital growth. Your next lesson involves a new spreadsheet to look at the ROI over a 5-year period. including accumulated cash flow and capital growth. That's another lesson down, guys. Look forward to seeing you on the next one.
Hey guys, we're now going to look at the return on investment ROI 5-year calculator. This is probably the most important spreadsheet you need to understand to be a sophisticated commercial investor, and will separate you from the novice investors who generally just calculate cash flow and that's where they're done with it. This spreadsheet is really important because it's where you'll actually be able to compare multiple investments, because you'll be able to look at how your commercial property compares with shares or residential and get a true understanding of exactly where it sits in the grand scheme of things. So let's have a look at the spreadsheet. Any cell that's in orange, you can change the value of. So that's such as the purchase price, the deposit amount, the loan interest rate, and this is for an interest-only loan comparison. The net rent, so that's the net yield effectively on the property as well. So $60,000 on $1 million is a 6% net yield. The rental increases, I've been conservative there at 3%. You'll typically get much higher than that. And depreciation, which you get back on tax time. So let's have a look at how the spreadsheet actually works. On a $700,000 debt, you can actually see you're going to have a loan interest of $35,000 per year at a 5% interest rate. Now let's have a look at what rent we get. So we get $60,000 per year if it's a net lease on this $1 million property, and we're allowed for 3% rental increases, which is quite conservative. So you can see each year it's increasing a little bit. At the end of 5 years, we're $67,000 a year income from the tenant. Each year we get $3,000 a year back on tax. Middle-aged building, for instance, normally 15 to 20 years on $1 million purchase will get you around this. And then we can look at the cash flow. So this is where most commercial investors stop. So we'll have in the first year, we'll have $25,000 a year cash flow, which is basically the loan interest subtracted off the $60,000 rent. And then we can also look at after tax. If we include the $3,000, what post-tax cash flow is going to be. See, on this scenario, it's $28,000. If we forecast this over the 5 years with the 3% rental increases, you can see at the end of it, you get around a $35,000 a year passive income from this property, which is fairly reasonable assumptions. The next step is we actually look at the return on investment, which is the ROI. So we look at this based on the acquisition costs. So this is the money you're putting into the property, and this is more comparable to shares where you might not be leveraged, for instance. So in this scenario, you're looking at a $300,000 deposit plus $34,000 stamp duty, plus additional purchasing costs such as legals and searches and building pest inspections and things like that. So your total acquisition cost is actually $337,500. We then compare this for what we actually get in regards to cash flow and look at the return on investment. So pre-tax, we're getting $25,000 a year cash return on that $337,000. So quite simply, we look at it as a return on investment, the percentage of that actually yields. So we actually then look at return on investment, which is what we actually get on the money we're putting into the deal. So on this scenario where it's $337,000, we're getting $25,000 a year pre-tax or $28,000 post-tax on that investment, which ends up being a 7.4% or an 8.3% return on investment on our money, which most people that own the shares will kind of go for that anyway. They'll go for the 8 to 10%, and that's why they'll say shares is better than commercial property. However, if we actually look at combining that return plus the capital growth, again, very conservative of 3%, we start to get some more interesting figures. So if you look at the cash flow, which is the $25,000 plus the $30,000 a year capital growth, these numbers then become more attractive. So in the second year, first year remains the same because we haven't seen the capital growth yet, but second year, it actually jumps to 24% and 26%. That type of return on investment, literally investors dream of in the share world. So this is where commercial becomes really powerful. Where this becomes even more powerful is if we can get the assumptions that we actually want. So let's just say we got 5% fixed rental increases for 5 years. You can see this makes the numbers much more attractive where we get like a 26% return on investment and then a 45% and then 66%. So you can see within, say, 6 years or so, you've actually paid back your investment, which is a really good return. If, for instance, interest rates came down to 3%, then it becomes even more attractive. If they went up to say 7 or 8%, then the yields become a bit lower. So getting your head around this spreadsheet is really important because it'll actually show you a true comparison between residential, commercial, and shares, and you can make an informed decision moving forward. If you've got any questions, please reach out. I'm more than happy to walk you through the spreadsheet personally. Cheers, guys.
Welcome to your next lesson where we're going to look at capital growth. So what actually is capital growth? Capital growth, sometimes known as capital appreciation, simply refers to the increase in value of your property over time. The commercial property market moves in cycles, much like the residential market. The key difference is the commercial market cycles generally lag behind the residential markets due to much longer lease periods. When it comes to the market cycle of commercial properties, the capital growth of each property can vary a lot based on its type, purpose, location, and demand. That's why it's a good idea to think long-term when buying a commercial property, because it has a high entry and exit cost. But if you do your research and due diligence carefully and make informed decisions, you can minimize the risks of market fluctuations and aim for good profits and capital growth in the long run. A good tip is to follow large national companies moving into a suburb or area, which indicates future growth. These businesses spend a large amount of money researching different areas, so they don't risk losing their capital investment in the property should the business not succeed. However, make sure the big national company would not be in direct competition with your investment, such as a new supermarket when purchasing a small convenience store. Let's look at the different phases of capital growth in the market cycle in more detail. The market cycle. This diagram illustrates the cycle of the commercial property market clock with the 4 phases: slowdown, recession, recovery, and boom phases. The cycle is very similar to the residential property clock, but has a few different impacts compared to the residential cycle. Let's look at each of these phases in more detail. Slowdown. The slowdown phase is characterized by an increase in new construction and vacancy rates as developers and new constructions come into the market, leading to an oversupply. The rise in vacancies can also be due to a pullback in demand caused by a shift in the economy. During the beginning of this cycle, the rents continue to rise, but more slowly. This becomes a buyer's market, as there's more stock available than is being bought. As more properties are listed online and more for lease and for sale signs go up in the area, rents will begin to fall. Some investors will become nervous during this phase and decide to sell due to the risk of a recession. Recession. Many people hear the word recession and think that means severe negative growth and the market is going to go far backwards, but it can just be a flat period where prices sit for a long period of time. In a recession, vacancy rates rise substantially as new properties hit the market. During this time, many landlords offer rent concessions to try to retain their tenants, causing rents to become more competitive. Developers who are late to the game will start offloading stock at below market prices before the recession hits. As supply saturates the markets, property prices will decrease and rent growth will be negative or below the inflation rate. If you're an investor, this is a great time to buy at a discounted price to hold the property long term and wait for the market to move into the next boom. Recovery. No new construction and high vacancy rates characterize the beginning of the recovery phase. Rental rate growth is still negative or flat, and owners continue to offer rental concessions to avoid vacancies. As the market conditions begin to improve and the population grows, more businesses will move into the area, demand increases, and vacancy rates will begin to tighten again. Interest rates may fall and the market will begin to grow again. It is still possible to pick up a bargain price property during this phase to hold on until the boom phase, although this will become more difficult as demand increases. Always ensure you buy a fundamentally solid property in a great location and to capitalize when rents increase and leases are renewed. This becomes a seller's market as vacancies lower and prices rise, which leads us to the boom phase. In the boom phase, the most capital growth occurs as increased demand pushes up rents and yields. With falling vacancy rates, developers start to build more commercial properties. While property prices are increasing and this is a seller's market, a buyer may profit by purchasing a property with perceived defect at a discount, such as a rundown property that needs renovating. An investor could also look at properties where the tenants are paying below market rent and increasing the rent, or moving tenants on short leases to longer leases, or even changing the tenant completely for a more attractive business. During this phase, gross domestic product, or GDP, is usually back at normal levels. At a high point in the boom, supply and demand are evenly matched until developers release their new stock, causing a shift in demand as tenants seek more competitive rents and newer buildings, thus causing the move back to the slowdown phase. During this market cycle, there is also a different cycle at play, which is emotions. The cycle of market emotions. Emotions can have a huge impact on the real estate industry. When people are feeling optimistic, excited, fearful, panicked, or hopeful, it can cause huge swings in the market and can cause it to either grow rapidly or decline sharply. What's interesting is that these changes can happen without any real economic factors at play. That's because humans tend to act in a herd mentality and follow the crowd. We also sometimes buy things with our hearts instead of our heads. When a lot of people start feeling a certain way, it can create a snowball effect. These emotions can be location or asset type based. For example, you may have a few people mention a hotspot suburb, the news starts spreading, and suddenly everyone you talk about is buying in that suburb because they've been told it's the next hotspot. The price of goods, such as investment properties, is an emotional worth of how much value we put on a property. Let's talk through the wave of emotions. When property prices rise, optimism and excitement build. As the cycle approaches its peak, emotions are at the highest point. People love property as they make money, and there are a lot of buyers. This is the maximum financial risk for buyers as it is seller's market, and buyers will generally lose out by either overpaying or missing out entirely. As prices fall, many buyers who have ridden the wave feel anxious. Buyer's remorse and worry start to creep in. Fear increases as the market drops, and some owners will look to sell to minimize losses. This becomes a buyer's market, with more buyers than sellers. When the property price approaches the bottom of the cycle, there is even more fear, and the doom and gloom will be reflected in media reports. Some owners will panic sell, which brings us to the point of maximum financial opportunity where you can pick up some good commercial opportunities at a bargain price. Eventually, however, the market starts to rise. This is where people re-emerge with hope and optimism, and we move back into the excitement at the top of the market. Many buyers and sellers use the stock market as a guide to when buying or selling commercial property. But actually, this approach can make buyers feel scared instead of confident, and it can be a trigger for some at the cycle of a market emotions. It's better to take a long-term approach and consider the risks involved over the next 5 to 20 years, no matter what the current market. That way you can make informed decisions based on both short and long-term factors. How many of you have heard the comment that commercial property does not experience capital growth? As mentioned, this is a complete myth. So, how do we actually get capital growth in commercial property? Let's look at all the different growth factors affecting your investment. Growth factors. There are several factors that affect capital growth for commercial property and feed both the market cycle and the cycle of emotions. In residential property, capital growth is somewhat one-dimensional, driven by supply and demand. Commercial properties are influenced by factors such as the overall economy, interest rates, and government spending on infrastructure. At the individual property level, the property's attributes such as the tenant, the length of the lease, and changes to the rent or cap rate can affect capital growth. Let's explore each of these in more detail. The economy. A strong or strengthening economy is essential for increased commercial property prices. As the economy starts to grow, there will be a rise in demand. Initially, there will be a greater demand for services, such as warehousing, to accommodate storage, supplies, and manufacturing. This will be followed by demand for retail space, as consumers become more confident and spend more. These include service-based industries like hairdressers, medical properties, and bakeries. This increased confidence generally leads to a surge in demand for office space. However, with COVID and the shift from working from home, the demand of office space has changed. On the other hand, an economic downturn may present opportunities to invest in a lower priced property, which can result in higher returns. Some of the economic factors that affect commercial property prices are gross domestic profit, GDP, wage growth, unemployment rates, household saving rates, migration levels, changes in taxes or tax rates, and changes in the overall population. Interest rate changes. Interest rates are constantly in the media and discussed throughout the investing community. Of course, interest rates will directly affect a commercial property's price, as they will change the cash flow for the property. A lower interest rate will increase the cash flow, which means buyers are willing to pay more for the same property. This can drive down cap rates and make the value of properties go up. However, when the Reserve Bank raises interest rates to manage inflation and slow down the economy, the high cost of money slows the rate of growth. At the same time, higher rates can slow the demand for both commercial and residential property, and consumer spending is reduced. Infrastructure spending. The development of infrastructure, such as major roads and freeways, will increase demand as commercial properties are required to complete the project. Good infrastructure projects mean improved access to a region, resulting in population growth and more development. An area with an increasing population requires more services, and as the new region develops, businesses will move in and different types of commercial properties will be built to service this demand, thus providing capital growth. Looking at what infrastructure is coming to a region is covered as part of your due diligence when looking at any investment. Individual property factors. The individual property itself will always affect the value of the property. The age of the building, its services, and the location can all influence demand. If the property has development potential or council zoning changes, this can instantly affect its value. For example, if you have a property zoned from low density to high density, more value has instantly been created as this has gained developer appeal. Tenant and lease length. As we know, a commercial property's value is closely tied to the tenant and the length of the lease. As a tenant approaches the end of the lease period, confidence in the property can drop, meaning fewer buyers and a lower sale price. If you have a property on a fresh 5 or 10-year lease, you will have more buyers, creating more competition and increasing the demand for that property. The cycle of emotion comes into play here, where more people want the property, so they pay a premium for it. Even if it doesn't perform better than something on a shorter lease, you have created capital growth through buyer competition and demand. The type of tenant can also play a part in the likability of the property. If you secure a good blue chip tenant like a Bunnings or an IGA, your property becomes more attractive and more buyers will push the price up and lower the cap rate. Rental increases and cap rate. Finally, we have the power of rental increases and cap rate. Increasing rent will automatically increase capital growth for the property. If the cap rate changes due to the growth factors we mentioned earlier, either positively or negatively, this will affect the property's value. Let's take a look at an example and run some numbers. Here we have a dental clinic getting 3% rental increases each year, which equates to 3% capital growth, even if the cap rate stays at 7. If you can get a higher rental increase in your lease with the tenant, say 4 to 5%, the capital growth will increase. At the moment, in a high inflationary environment, we're actually seeing more than 5%, so we're getting even more capital growth. We're not talking about cap rates tightening, just remaining the same. Simply put, the greater your net income from the property, the higher the property value. If you can get cap rate compression, the property value will increase even more. So in this example, we can see that in year 1, if the cap rate dropped to 5, you have made over $350,000 just by the cap rates compressing. However, if the cap rate changed to 9, then you can see this property has lost value. The aim is always to buy in a region or a particular style of property with increasing demand and a lowering cap rate, as this will dramatically increase your value. Capital growth calculator. To finish things off, we have another spreadsheet for you because, as you all know, I love a good spreadsheet. In the downloads, you will find the capital growth calculator and graph. You can see that a $1 million property with a growth rate of 5% per year will be worth $1.5 million in 10 years' time, and over $4 million after 30 years. You can update and change the purchase price and the annual growth rate percentage to see how much your property could be worth in 30 years. Thanks for watching again, guys, and see you next lesson. Welcome to the next topic of the module, where we're going to look at how to grow a portfolio. As we've already discussed, there are a number of factors that affect commercial property return. When you're trying to build and expand your portfolio, capital growth and cash flow return are fundamental. Growing your portfolio comes down to the basics of compounding leveraging. First, let's look at the concept of compounding. Compounding happens when you earn a return on an investment and you reinvest those proceeds. In other words, if you earn an income on the capital that you've invested, then that income is added to the original capital to begin with. This means you now have a new higher amount which will earn more income in the next period. Let's think about this in simple numbers. Say you have $1 and you invested at a 10% return. At the end of a year, you have $1.10. The next year, you'll start with that $1.10 and earn 10% return on that, and so on. This greatly accelerates your growth of income over time as you're earning income on income. Let's have a look at this graph to highlight the compounding returns. If you invest $100,000 at a 7% annum interest rate and it's compounded monthly, then in 10 years' time, you would end up with $200,966. Whilst compounding is commonly associated with interest, it's also an incredibly powerful concept when applied to capital growth of a property. For example, if an investor purchases a property valued at $1 million and this property grows 5% per year, the property will increase in value to $1,050,000 over the first year. Think back to the last lesson on capital growth and our calculator. You can use this to forecast the compounding capital growth of any potential property. This increasing trend will continue, with the value of the property and the equity in the asset increasing exponentially over time. Remember, the property may grow 10% one year and only 1% another year, but you'll use the average growth over the long run. Whilst it may not appear to have a huge effect immediately, compound growth increases by more and more each year, and this snowball type effect can have huge benefits for property investors who hold onto an asset for a long period of time. Let's look at our same $1 million property again. With an annual growth rate of 5%, in 10 years' time the property will be worth over $1.628 million, showing an increase in $628,000 compared to its original purchase price. Whereas a non-compounding asset would only be worth $1.5 million and have only increased by $500,000 over the same time period. You can think of it like the $500,000 in growth has created its own $128,000 in equity due simply to the compounding nature of property. The equity could now be leveraged to purchase a second investment property, which will accumulate equity through compound growth. The main key to compound growth and property investment is time. Going back to this example, if the investor held onto the property for a further 10 years, it will now be worth over $2.6 million after a period of 20 years. Now, imagine the potential if you had multiple properties in your portfolio. That would be life-changing. But how is this achievable? Most people don't just have $1 million to spend on a property, let alone multiple. This brings us to the second aspect that is important when growing our portfolio, and that's leverage. Let's pretend you're working towards a $5 million commercial property portfolio. Without leverage, you would need to buy these with cash savings. Let me ask you a question. Will you ever be able to save $5 million, $3 million, or even $1 million? Most people will say no, but how long will that take even if you could? This is where leverage comes in. So, what is leveraging? Simply put, leveraging is borrowing money to invest. Through leveraging, investors can commit a smaller upfront cost while still gaining access to the asset. The primary idea behind leveraging in real estate is to use other people's money to increase your returns without investing much of your own funds. Real estate is one of the few investments where lenders will allow you to leverage significantly. Think of our 95 and 100% loan-to-value ratios. When you combine this leverage with compound returns, you can achieve growth on a large scale. Whilst the positive returns can be great with property, you still need to be cautious on taking on huge amounts of debt. Beware of the potential negative effects of leveraging. Having a comfortable loan-to-value ratio, as well as buffers in place, is important to mitigate the risk with your portfolio. For the most part, lenders will keep you in check with each deal, but this may not be the case with private lenders or vendor finance. So, we've decided to use leverage to build our portfolio. You need to consider some factors when deciding how much to leverage. These include your risk appetite. How much money can you risk? What commitments do you have? Do you have dependents? Ask yourself how much cash or equity you have and how aggressive you want to be. For example, if you're a high-income earner with lots of liquid savings, you may take on more risk than a low-income earner with minimal savings. Your goals. Think about your short, medium, and long-term goals. Remember, these goals are based on what makes you happy. Be realistic about what you actually want and what you're prepared to sacrifice to achieve it. Don't just chase a passive income number or quantity of assets just for the sake of it. Your time frame and exit strategy. Ask yourself what time frame you would like to expand the portfolio to achieve your desired cash flow. You also need to have an exit strategy planned. Will you sell one or more properties to pay down the debt? Will you also have a family home or principal place of residence that you need to pay off at some point? These questions and all the different factors need to be planned and discussed in depth before you just rush out and buy property. Whilst leverage can help unlock new opportunities in a commercial property strategy, investors should always consider the risks and measures involved. Whilst you may do lots of research, a property may not always perform to your expectations in your required time frame. It is best to always purchase with a margin of safety. Generally, not every property will be an amazing performer, as there are too many market variables to get everything right 100% of the time. Of course, if you focus on a solid property that has the right fundamentals, you can minimize risk and will normally do well. Just as I mentioned when looking at cash flow, you need to stress test your portfolio when considering leverage. How is your property going to perform at higher interest rates or with periods of vacancy? You need to ensure you can financially handle these situations. A mistake that investors make is not having sufficient cash reserves for unexpected expenses. Remember, if your property does become vacant, you'll need that buffer to not only pay the interest on the loan, but also the insurance, rates, maintenance, and other expenses that fall due to the property not having a tenant. When choosing a buffer amount, you need to consider what's appropriate for your risk profile, how many properties you own, your responsibilities, your income, and the typical vacancy rates of your properties. For example, you may decide to hold 12 months of cash buffer if you have one industrial property. But if you have 3 properties, you may not need to have 3 years of buffer, as you won't expect all 3 properties to be vacant simultaneously. So, the theory of compounding growth and leveraging seems to offer a pathway forward where you can keep buying more properties until you reach your final goal. Yet, the data shows that very few property investors own more than 2 properties, particularly residential ones. So, why does this theory not work in practice? Why doesn't everyone have a big portfolio? Mainly because you have a glass ceiling in residential and most people hit a limit with their serviceability. Because commercial investments are highly positively geared properties with strong cash flow, you can often keep buying using compounding leverage. Even if you hit some form of limit, you can also access different lending options which will help you build the portfolio. We learn more about these later in the course. By now, it should be clear that the best way to build a substantial asset base is to leverage and compound the growth of solid, well-located properties that are in demand with low vacancies. But of course, it's always easy to understand when you have an example. Jump into the next lesson where we'll be looking at a sample portfolio based purely on commercial properties. It will show you how using compounding leverage and steady rental growth can allow you to achieve $100,000 passive income in just 10 years. Thanks for watching, guys. See you next lesson.
Hey guys, we're now going to have a look at the commercial property 10-year property plan calculator spreadsheet. Going to give you a run through of all the inner workings of the spreadsheet, how to use it. But this spreadsheet is generally just an overview to see what you can actually accomplish in commercial property if you kind of aggressively try to keep accumulating some assets over time. As you know, there are 3 ways to grow a commercial property portfolio. One is through the cash flow of the property, so you use that as savings for the deposit for the next one. The other one is through additional contributions, which is your own savings, for instance, so how much you and your partner, for instance, could save for the next property, and equity, so i.e. how much the property has in capital growth. So if you put all them together, what can you get for the next property, and then how would that look, so on and so forth. In this spreadsheet, you can change any of the cells that are in orange. So the interest rate, the rental increases, the cap rate, the additional yearly contributions, and the first value property. This spreadsheet is just illustrative to show you what's achievable over, say, 10 years' time. And we can make up your own spreadsheet for your own personal circumstances and your portfolio, or there is some property planning software I can recommend if you need as well. Now let's get into it. Basically on this portfolio, we've got a 5.5% interest rate, 3% rental increases, and I've also associated capital growth with 3% as well to match the rental increases, because in a fairly flat market, that's what normally happens. However, at the moment, we're seeing 10 to 15% rental increases, but generally the 30 average is around the 5 to 7%. So we'll leave it at 3 to be conservative. 6% is if you're buying the portfolio at a 6% cap rate or net yield and it maintained this cap rate. And then $30,000 is additional contributions to the portfolio each year, which you and your investor partner, for instance, may put together to get into the next property sooner rather than later. So let's have a look at the numbers. Let's say we start off with $1 million purchase price on your first property. With a 70% LVR, that equates to a 700% loan, and you're going to have interest on that loan. So an interest rate 5.5% on $700,000 with a net rent of $60,000, you're going to end up with around a $20,000 cash flow from this property in the portfolio. Combining this with additional contributions of $30,000 each year, and then 3% capital growth, which is matching the rental increases, you can see after a few years' time, you're going to end up with about $70,000 accumulated cash flow. So that's the cash flow from year 1 plus year 2 plus year 3 ends up being $70,000. The additional contributions of $30,000 a year, you're going to have $90,000. And then with 3% capital growth, you'll have $60,900 equity in that property. So basically we use all these three together. So the cash flow plus additional contributions plus 70% of the growth equity. I want to point that out. And then that leaves us with $202,000 to use for property number 2. So that equates to around a $580,000 property for number 2 within 3 years. The same formula applies where instead of having the cash flow on one property, we've now got it on 2 properties, for instance. So the first one's now $23,000 passive income. The second one's $12,000. Similar with additional contributions, we're maintaining the $30,000 per year. And then the growth equity, because we've got 2 properties, is much larger. So in the next 3 years, we actually end up with $278,000 we can use for the next property. And then so on and so forth. You can see after year 9, we can buy another property at $1 million. And then the yearly cash flow is going to be $85,000 per year, which is a really good outcome for 10 years when you've just started with the one property, for instance. And if you compare this with residential, it's much better. Residential portfolios take 20, 30 years to get even remotely close to this passive income. And you've got a portfolio size of close to $4 million. So this is actually quite good, and it's leveraged at 70% as well. So let's just say the portfolio doubled in the next 10 years' time. You'd end up with an $8 million portfolio, and you're going to have $5, $6, $7 million net portfolio value to be able to use. And if the rents double, for instance, you're going to end up with about $180,000 to $200,000 passive income from the portfolio. And this is where commercial becomes really powerful. The other thing I want to show you is what happens when we change some of these numbers and what the output looks like, because writing plans is actually the simple part. As I've just shown you, it's fairly simple mathematics. The hard part is actually getting the properties that actually meet these assumptions. So we can change any of this. We can say, what happens? Oh, look, Steve, we're getting 8% interest rates at the moment. What does the cash flow look like? So you can see if we keep getting 8% and we only have 3% rental increases, we actually end up with a $12,000 passive income after 10 years, which is not as strong at all. But generally what we see in the market with high interest rates, you have high inflation. So we're seeing that at the moment, and then rental increases aren't just at 3%. We're actually seeing 10 to 15%. So let's just say if we have a 12% rental increase, okay, we start building that passive income again. If we go, say, a 7% cap rate, we look how that changes. Now $158,000 passive income. What some normal numbers that we'll look at is probably like a 6% interest rate with an 8% rental increase on average and a 6% cap rate. And we're looking at literally $130,000 passive income. The other powerful thing is if you can actually put a lot of money into the portfolio sooner to help build the deposits, you end up with a much bigger outcome. So let's say if you've got 2 investors together and they're saving $25,000 a year each and they put that to it as $50,000, you then end up with 150 grand passive income after 10 years, just from following some fairly rudimentary assumptions. So have a bit of a play with this spreadsheet. If you've got any questions or want me to help you generate your own spreadsheet for your own personal circumstances, please let me know. I'll reach out. If not, happy investing.